Welcome back to another episode of Markets in Under 5, where I cover everything you need to know in the stock market in less than 5 minutes. Let's not waste time, let's get into it right now. If you are not living under a rock, you know that Israel and Iran are now going back and forth with each other with the potential start of a new war in the Middle East. We have Trump claiming that he's essentially come to a deal with China and they're working on the final bits and pieces of it. We also had Bessent come out saying that there are going to be plenty of trade deals coming to fruition in the next few weeks, so we'll see how that plays out. And of course, we have the S&P 500 coming close to all-time highs, obviously pulling back after the Iran-Israel news. So much stuff to cover in this video. We're going to look at stock market performance relating to wars going back in history and see how we can use that information to take advantage of some deals in this market. There's a lot of confusion about how the markets perform in relation to war. So starting off, let's look at the S&P 500. We were very close to all-time highs, reaching about 1.3% away from all-time highs. After the Iran-Israel news was announced and the war began, we are seeing a approximately 1.5% decline in the S&P 500, and I don't think that this move is over yet. I think we have a lot more room to the downside in the short term. Obviously, there's a large gap on the S&P 500 that is yet to be filled. We did touch into it here on this down move, but I do believe we still have the potential to come back and fill this. We also have the 200-day moving average resting right here, but it's not just technicals that make me think that we're going to sell off here. Obviously, with the war situation, we have to look at previous data with wars and see how that correlates to stock market movement. Based on Grok research, we can see that the S&P 500 typically declines in the month the war starts, with an average of between 7 to 9% in recent cases, and normally we get a recovery within a 6-month period. After the Gulf War, we had a 13.8% increase. Obviously, this was the 90s. We can also look at the Ukraine War, which started in February of 2022. The initial move was a 7% decline, but we rebounded almost entirely by the end of the month. For the Gulf War, by August of 1991, we were up 20.2% from the end of August in 1990. The Iraq War in 2003 saw stock market recover strongly, with the Dow Jones gaining over 30% from its March low. So I'm not obviously going to go into detail on every single war that we've had over the past 30 years, but a conclusion from Grok shows that the S&P 500's response to war typically involves an initial decline. We saw an average of about 7 to 9% in the wars that we looked at, followed by a recovery within 6 months and significant gains within a year, reflecting the market's ability to adapt to geopolitical shocks. So unfortunately, even though war is a terrible thing, and I'm not advocating for it whatsoever, and if we look at the markets, you cannot deny they are ultimately bullish in the medium to long term. So if and when we do get a decline down into this gap on the S&P, this is a spot I'm going to be adding to my long-term positions. I will also consider doing some short-dated calls on the QQQ and the S&P. Of course, those will be alerted in the community when I do that. If we are able to fill this gap fully, we're looking at a decline from the internal high here of about 6%, which equates almost perfectly to that data we just looked at of declining 7 to 9% at the start of the war in that first month, and ultimately making higher highs and pushing further in the next 6 months to 1 year. If Bessent is correct and we do end up coming up with some additional trade deals on major markets like China, this could also be a propellant for the markets and could also be part of the reason why the markets drive higher after we're able to fill this gap. Obviously, I gave you guys my ads if you look at previous videos and my trading community when we were down 10 and 20% on the S&P. Here are my ads in early March for the S&P 500 when we were down 10%. Here are my ads on QQQ when it was down 23% and the S&P 500 was almost down 20%. Look at the date on April 8th. That literally marked the bottom in the market. And of course, we are banking heavily on a lot of other stocks. Nvidia, Amazon, Toyota, Oxy now pushing after the whole war situation happened as oil is rising significantly. Google, Tesla, and ASML all performing well. My worst performer right now is Nike, but I do think this still has some legs in the long term. I'm consistently adding to this position. I'll cover that in a second. Tesla was some major drama. Obviously, there was a feud between Elon and Trump, and we saw a massive decline in Tesla. And amazingly, we were able to make a almost full recovery here, filling the gap here that formed after this Trump news came out. I think Tesla has some legs to go. Ultimately, I'm looking for this monthly fair value gap to get filled fully, meaning that Tesla should test the 373 level. We'll see how the robotaxi event plays out. ASML, I think, still has some incredible legs on it. We had our major ads on ASML between that 650 and 580 range. I'm up about 20% on this position right now. And if you look at the weekly chart, we do have a pretty big gap here on ASML that I think has the potential to be filled before we go higher. So if we are able to go back down into the 715 to 700 range, I think this is a good spot to start adding for the long term. If I take anything on this, obviously it will be alerted in the trading community. Ultimately, I think this has legs to go back up to this 811 range and then potentially back up to these internal highs and ultimately all-time highs for ASML. They're obviously a monopoly in the lithography space, so keep this one on your watch list. Our Boeing position also doing incredible here. Our major ads came down here in a 150 range, and I was able to take profits at this internal high at 188, this internal high at 196, and finally, my final take profit was able to hit last week in this 214 range after touching into this monthly fair value gap. And for the haters that don't believe me, timestamped here on X, you can see I posted I was up 41% on Boeing since our ads in April. And once we tagged into this monthly fair value gap, I said I am now completely out of Boeing, even though I still think this has legs to run higher, which I still think it does. But ultimately, I was able to take my full position before this whole decline. And lastly, Nike is one that is on my watch list. I have been adding this heavily in the low 60s. It has a very similar situation going on with Boeing, where we have a unfilled weekly as well as a monthly fair value gap here in the 90s. So I think adding Nike for the long term here to ultimately target this 98 and this 110 level is a good risk to reward. If we start seeing Nike trading back below this low that was formed in early April, then I think this is probably a spot that you should be cutting this position or at least reducing size on it. But ultimately, I do think Nike has some strong legs to take out all of this low resistance liquidity, this buy side liquidity, monthly and weekly fair value gap. And guys, so many different plays I can go over here, but I'm trying to keep these videos under 5 minutes. There's a few higher risk plays that I really like that I called out in my community. If you guys want access to all of my long-term plays, all of my swing trades, all of my day trading, a link will be in the description below. Catch you on the next video.